Welcome to the deep dive. Today we're digging into a really interesting story. How does a company born from market turmoil consistently turn, well, chaos into opportunity and maybe position itself as significantly undervalued, even with all the catastrophic events and inflation we're seeing?
Exactly. We're talking about Arch Capital Group, ticker ACGL. It's a powerhouse in specialty insurance.
And our mission today is to really unpack their business model, figure out what makes them tick, what their competitive advantages are, how do they not just survive, but actually thrive when markets get volatile.
We'll be looking at their strategy, their financials, and also what the market's thinking about this S&P 500 company right now.
All right. And this deep dive, it's informed by a detailed report, ACGL Deep Stock Research, which comes from Stock Analytics AI, these really in-depth stock reports. So just to set the scene, as of June 27th, 2025, ACGL closed at $90.32 a share. We're going to approach this from a value investing angle. Try and understand the business, its edge, the leadership.
Yeah. Get into the nuts and bolts. There might be some surprising facts, some real aha moments along the way.
Okay, let's get started. Chapter 1, Business Analysis.
So, Arch Capital Group. It's a global company, technically based in Bermuda, but operating everywhere. Their main game is specialty insurance and reinsurance. What's really clever, I think, is their structure. It's built around these three distinct but very complementary operating segments: insurance, reinsurance, and mortgage.
Okay, three engines. So how do they actually make money? You hear about insurance companies, but what's Arch's specific approach here?
Well, it really comes down to two main streams. First, there's the underwriting income. That's the profit from, the actual insuring part. You take the premiums they collect, subtract the claims they pay out, plus expenses.
Right, the core business.
Yeah.
And that key metric is the combined ratio.
Exactly. Below 100% means they made a profit on the underwriting itself. Arch reported 94.8% for 2024, so profitable.
Yeah, solid, but you said two streams.
Yes, and this is crucial. The second is net investment income. This comes from the float. That's the huge pile of cash they collect from premiums before they have to pay out claims.
Ah, the float. Buffett talks about that a lot.
He does. And for Arch, in 2024, this float was, well, staggering. $41.4 billion. And they get to invest that money.
$41 billion. Wow. Okay.
So this dual stream, making money from careful underwriting and investing that float, that's really the fundamental engine driving value at Arch. They're good at both.
Yeah. So let's break down those three segments a bit. What's in each one?
Okay. The insurance segment handles specialty property and casualty. Think things like healthcare liability, cyber risk, surety bonds. Complex stuff. They call it intellectually intensive markets. That segment wrote about $6.9 billion in net premiums last year.
Okay. The tricky stuff. Then reinsurance.
Reinsurance is basically insurance for other insurance companies. Arch is a big player here, a global leader, easily top 10. They wrote a record $7.7 billion in net premiums in that segment in 2024.
Insurance for insurers. Got it.
Oh.
And the third one, mortgage.
Yeah, the mortgage segment. This provides private mortgage insurance, mostly in the U.S., but also internationally. They actually became the world's largest mortgage insurer after they bought United Guaranty back in 2016.
The largest. Wow.
Yeah, it's significant. They're actually the single biggest source of counterparty risk to Fannie Mae and Freddie Mac because of it.
Okay, so definitely not a small niche player then.
Not at all. We're talking a $24.3 billion capital base, around 7,200 employees, over 60 offices globally. They're substantial.
And their whole value proposition, their motto is enable possibility, providing solutions for tough risks.
That's the idea. It's guided by these three pillars. Go after diverse specialty markets, stay agile, and always, always maintain disciplined underwriting.
Okay, so that's Arch. What about the playground they're in, the P&C and reinsurance industry? It's known for being cyclical, right?
Very much so.
Yeah.
You have hard markets where premiums go up and it's harder to get coverage, and soft markets where competition is fierce and premiums are lower. Right now, it's kind of mixed.
Mixed how?
Well, casualty lines, things like liability, are generally hard. A big driver there is something called social inflation.
Social inflation.
Yeah.
It's like rising litigation costs and bigger jury awards.
Exactly. It's not just regular inflation. It's societal trends making claims more expensive. But property lines, like homeowners insurance, are actually starting to soften a bit after years of big rate hikes. And the mortgage segment, obviously, its health is tied pretty closely to the housing market.
And who are they up against? Who are the big competitors?
In specialty and reinsurance, you're looking at global giants. Think Chubb, AXA, XL, Munich Re. For mortgage insurance, it's more like Essent, MGIC, Radian.
Okay. And regulation must be a huge factor, too.
Oh, absolutely. Insurance is heavily regulated. In the U.S., it's mainly state by state, coordinated by the NAIC, the National Association of Insurance Commissioners. Their Bermuda base gives some advantages, but also exposure. Like Bermuda recently brought in a new corporate income tax.
It sounds incredibly difficult to just start an insurance company like Arch from scratch today. The barriers seem huge.
They really are. You need massive amounts of capital just to start. Then there's navigating all the complex regulations, building the relationships, which take years, decades even, and developing that specialized underwriting expertise. It's incredibly hard to replicate.
So that difficulty, that's their competitive advantage, their moat, as Buffett would say.
Exactly. That's what allows a company to earn high returns consistently. Arch's moat, it's built on a few things. Their brand strength, they're known for expertise. Economies of scale, being global, helps absorb big hits. And switching costs, relationships, and trust matter so much, clients don't switch lightly.
But you mentioned underwriting discipline before. Lots of companies say they're disciplined.
Right, but Arch seems to actually live it. That's maybe the core intangible asset. It's their culture, their strategy, prioritizing profitable underwriting over just writing more business, even if it means walking away sometimes. That seems foundational.
And how does that three-segment model play into this discipline? You said it was ingenious?
Yes. This is where their mastery of cycle management comes in. It's not just diversification for diversification's sake. It's a masterfully designed engine. The key insight is that the mortgage segment often behaves differently from the P&C cycle. It tends to be more stable, providing steady capital.
So when P&C markets are tough after a disaster.
Exactly. When a hard market hits in P&C, usually after big catastrophes, Arch has this capital stream from the mortgage side ready to deploy. They can write new P&C business at very attractive rates while competitors might be struggling. We saw this clearly after the 2005 hurricanes and again after the 2008 financial crisis. They turned those crises into opportunities.
Turning crisis into opportunity. That sounds like a good management team.
Which brings us nicely to Chapter 2, Management Evaluation.
So who's running this show? Is it a team that's been through these cycles before?
Very much so. It's a veteran team. The current CEO, Nicholas Papadopoulos, he's been with Arch since 2001. He held really critical roles like chief underwriting officer before becoming CEO. That points to, a strong internal bench and good succession planning.
Okay, an insider. And you mentioned their performance in past crises. Can we look at those examples again, but from a management perspective?
Absolutely. Take the 2005 hurricane season, Katrina, Rita, Wilma, huge industry losses. But Arch management had already decided to be underweight in property cat risk. They took smaller losses. Then they immediately capitalized by launching a new vehicle, Flatiron Re, to write business at the higher rates that followed. Proactive and opportunistic.
Okay, so discipline before the storm, action after. What about 2008?
2008 global financial crisis. Again, discipline beforehand. Their investment approach was conservative. They didn't have direct exposure to Lehman or AIG stock blowing up on their balance sheet. They kept underwriting profitably, even pulled back from weak markets. And that financial strength during the crisis is what actually let them build up the mortgage business, eventually leading to that big United Guarantee deal.
So it really is a consistent pattern. Discipline, crisis, opportunity, strength. A repeatable playbook.
It certainly seems that way. And beyond crisis mode, they seem committed to transparency and ethics. They have a code of conduct, sustainability reports, regular earnings calls.
And what about internally? Happy employees?
Apparently so. They reported an 88% employee engagement score in 2023. That's 10 points above the industry average. That usually signals a healthy internal culture, which is important for executing that discipline strategy long term.
Okay, strategy and culture seem strong. What about how they use their money? Capital allocation is key, right?
Absolutely critical. And Arch is pretty clear about their approach. It's shareholder friendly. First priority, reinvest in profitable underwriting opportunities. If they find good risks at good prices, the money goes there.
Makes sense. What's next?
Second, reduce financial leverage, pay down debt, keep that balance sheet strong. And third, if there's still capital left over after those first two, return it to shareholders.
How do they return it? Buybacks? Dividends?
Primarily through share buybacks. They have an active program, authorized another $1 billion for it in late 2024. Bought back nearly $200 million worth in Q1 25 alone.
What about dividends? A lot of financials pay regular dividends.
Arch generally doesn't pay a regular common stock dividend. They prefer using that cash to grow the book value per share, which buybacks help with. But they're not afraid to return cash when it makes sense. They paid a huge special cash dividend in late 2024, $1.9 billion, which was $5 per share.
Wow, a $1.9 billion special dividend. That's massive.
It shows they're opportunistic. If they don't see internal reinvestment opportunities that meet their high return hurdles, they'll give the cash back. It's worth noting their preferred stock does pay regular dividends, just not the common.
And M&A. They seem to use acquisitions strategically, too.
Yes, but it looks like it's to enhance the platform, not just get bigger for the sake of it. That 2016 United Guarantee deal, $3 for BB, was transformative. It added that third counter-cyclical mortgage engine. And more recently, buying Alliance's U.S. mid-corp and entertainment book in 2024 shows they're still finding bolt-on opportunities for strategic growth.
So putting it all together, discipline, strategy, capital allocation, what kind of returns does this generate?
Well, management targets a 15% return on equity ROE. And for the full year 2024, they actually delivered an 18.9% after-tax operating ROE. Pretty impressive.
Yeah, hitting above target. Hey, let's look closer at the numbers themselves. Chapter 3, financial analysis.
All right, the financials. So as we said, market cap around $33.7 billion. If you look back over the last 5 years, say 2020 to 2024, it's a picture of really strong growth. Revenue more than doubled, $8.5 billion, up to $17.4 billion.
Doubled revenue in 5 years. That's significant.
It is, and net income, diluted EPS, free cash flow, all showed powerful growth over that period, too.
What about those profit margins? We mentioned the consolidated combined ratio was 94.8% in 2024.
Yeah, solidly profitable. And even better in Q1 2025 at 90.1%, despite some catastrophe losses hitting in that quarter. But here's a really telling number if you strip out the cats and the changes in prior year loss reserves.
Kind of the underlying core profitability.
Exactly. That core combined ratio was exceptionally strong in Q1 25, down at 81.0%. That really highlights their underwriting skill.
81%. That's fantastic for an insurer. And net profit margin overall.
It was 24.5% in 2024. Now, it spiked to 32.3% in 2023, but that was due to a big one-time non-cash benefit related to those Bermuda tax law changes, about $3.10 per share. But even if you normalize for that, EPS in 23 more than doubled from 22.
Okay, so consistently profitable, even with some noise. What about cash flow?
They generate a lot of cash. Free cash flow grew from $2.8 billion back in 2020 to $6.6 billion in 2024. That's the fuel for everything: investments, acquisitions, buybacks, those special dividends. It's the lifeblood.
And earnings consistency. Insurance can be volatile, but how has Arch done over a longer period?
Remarkably consistent growth, actually. If you go back to 2015, EPS was $1.36. By 2024, it hit $11.19. That's a compound annual growth rate of about 26%. Pretty stellar for this industry.
26% CAGR over almost a decade.
Okay.
And the balance sheet supporting all this?
Rock solid, often described as a fortress balance sheet. Their debt-to-equity ratio is very low, just 0.15 as of Q1 2025, and it's been trending down. Shows real prudence.
And that low current ratio we saw, 0.56, you said not to worry.
Right. For insurers, because of how they account for reserves and liabilities, the traditional current ratio isn't very meaningful. A low number, there isn't a red flag like it might be for, say, a retailer.
Okay, good to know. So strong growth, strong profits, strong balance sheet. How does the market value this? What are the valuation metrics telling us?
Well, on a relative basis, its trailing 12-month price-to-earnings ratio, the PE, is around 9.1. That's quite a bit lower, maybe 30% below its own 10-year historical average PE of about 13.1.
So cheaper than it has been historically.
Seems so. It also trades at a pretty significant discount compared to a larger peer like Chubb. And it's roughly in line, maybe slightly cheaper, than its closest mortgage insurance competitors like S and Radian.
Okay, relative valuation suggests it might be inexpensive. What about intrinsic value? Did the analysis try to estimate that?
Yes. Using a discounted cash flow, or DCF model, which tries to estimate value based on future cash flows, the analysis came up with an intrinsic value estimate of $139.55 per share.
Whoa! Okay, let's pause there. The DCF model suggests around $140 per share.
Right, based on assumptions of continued strong growth and using a discount rate of about 7.44%.
And the stock is currently trading around $90. So comparing that intrinsic value estimate to the actual share price suggests it could be, well, significantly undervalued.
That's certainly what the DCF analysis implies, a pretty substantial potential upside based on those fundamentals.
That's definitely an aha moment. Let's see what the market thinks.
Okay. Chapter 4, Market Sentiment.
So the fundamentals look strong, valuation seems attractive.
Hmm.
What's the general feeling on Wall Street towards Arch?
Broadly positive, actually. The analyst consensus rating is generally a moderate buy or buy, and their average 12-month price targets are clustered somewhere between $110 and maybe $114.63.
So analysts see upside too, like over 20% from the current price.
That's what their targets suggest, yeah. And recent news flow has mostly been positive, highlighting the strong results, the strategic deals, the capital returns.
What about market indicators, like short interest? Are people betting against it?
Not really. Short interest is very low, only about 1.26% of the float. That's usually seen as a bullish sign from institutional investors, suggests not many big players expect the price to fall significantly.
Okay, analysts are positive, short interest is low, but where is the stock actually trading?
And this is where it gets fascinating. There's a clear divergence. Fundamentally, as we've discussed, things look strong, analysts are bullish, but technically, the stock is currently trading below both its 50-day moving average and its 200-day moving average.
Below the key averages, what are those levels?
Around $92.40 for the 50-day and $92.20 for the 200-day, roughly. Trading below those often suggests negative short-term price momentum.
So the fundamentals in analyst views say go, but the recent price action says hold on.
Kind of, yeah. It raises that classic question. Is this technical weakness just temporary noise, maybe a broader market pullback affecting it? Or is the market sensing some fundamental flaw that the analysis or analysts are missing?
Right. And for a value investor, that kind of divergence, strong fundamentals, weak sentiment, can sometimes spell opportunity, can't it?
It absolutely can. If you believe the fundamentals are sound and the market is being overly pessimistic short term.
Interesting divergence. Let's look at who actually owns the stock. Chapter 5, ownership structure.
Okay, ownership. It's very heavily institutionally owned. A whopping 91.74% of the shares are held by institutions.
92%. Who are the big holders?
It's the usual suspects, the giants. Vanguard has the biggest stake, almost 42 million shares. Then BlackRock, with over 33 million. Artisan Partners holds a large active stake, about 23 million shares. Bamco Inc. and State Street Corp. are also major holders.
So a lot of big, stable money in there. What about insiders? Does management have skin in the game?
They definitely do. Insiders collectively own about 3.0% of the company. Now, 3% might not sound huge, but given the company's size, that stake is worth a substantial $1.0 billion.
$1 billion owned by insiders. Okay, that's definitely skin in the game. Alignment of interests.
Exactly. Now, there have been some recent insider sales. The chairman, John Pasquesi, sold about $9.3 million worth. But given his long tenure and the fact he still holds a massive amount, those sales could easily be for personal financial planning, diversification, things like that, rather than a signal about the company's prospects.
Right. You can't always read too much into individual sales, especially with long-serving execs. Is the ownership concentrated?
Reasonably so. The top 5 institutional holders control over 36% of the company between them.
So you've got this combination, passive giants like Vanguard providing stability, active managers like Artisan showing conviction, and insiders significantly aligned. That feels pretty strong.
It's what the report called a trifecta of validation. It suggests more than just broad acceptance. It implies deep conviction from different types of sophisticated investors.
Right, strong validation. But no investment is risk-free. We need to look at the potential downsides.
Agreed. Chapter 6, Risk Assessment.
Let's maybe start with a SWOT analysis. Strengths, weaknesses, opportunities, threats. What are the key takeaways there?
Sure. Strengths. We've hit these already. That disciplined underwriting culture, the diversified 3-pillar model, experienced management, the fortress balance sheet, those are core.
Weaknesses.
Weaknesses. The big one is just the inherent exposure to catastrophes. You can manage it, but you can't eliminate it, and it will cause earnings volatility sometimes. They're also smaller than the absolute mega insurers, which could be a scale disadvantage in some areas, and they rely heavily on complex risk models, which models can be wrong. Opportunities, definitely the current hardening casualty market that means rising premium rates, which helps margins. Also, the increasing complexity of risks in the world, think climate change, cybersecurity that plays right into Arch's Spendically expertise, and, of course, potentially more strategic M&A.
And
Threats. Intense competition is always there, both from traditional insurers and increasingly from alternative capital like catastrophe bonds. Regulatory changes are a constant threat, and that social inflation we mentioned earlier, rising litigation costs, remains a major headwind for casualty insurers.
Okay, so connecting those threats to the bigger picture, What about key macroeconomic factors? Inflation must be a big one.
Oh, absolutely. Inflation is a direct hit. It increases the cost of everything they pay claims on car repairs, building materials, medical bills. If they can't raise premiums fast enough to keep pace, margins get squeezed. It's a constant battle.
And interest rates. They have that huge investment portfolio.
Highly sensitive to interest rates. When rates go up, their investment income on new money coming in gets better, but the market value of their existing bond portfolio goes down. Falling rates do the opposite. It's a double-edged sword they have to manage carefully.
Are there any specific geopolitical factors highlighted, like those potential 2025 U.S. tariffs?
Yes, the report specifically called out the potential impact of the 2025 U.S. tariffs on things like imported vehicles, auto parts, construction materials. This isn't just abstract economics for an insurer like Arch.
How does it impact them directly?
Well, directly, it increases claims severity. If car parts or building materials cost more due to tariffs, it costs Arch more to settle those claims.
Okay, higher claims costs. Any knock-on effects?
Yeah, second-order effects. It forces insurers like Arch to push for higher premium rates, which regulators might resist. It can worsen supply chain issues. And third order, it might even change consumer behavior. Maybe people drive less or defer home repairs, which subtly alters risk profiles and means Arch has to adjust its underwriting models again. It creates ripples.
Okay, lots to consider on the risk side. Let's try and pull this all together. Chapter 7, Conclusion. So after digging into the business, the management, the financials, the market view, and the risks, what's the overall picture that emerges?
I think the deep dive reveals a company with a really powerful, arguably unique business model, very disciplined management, and based on the analysis, a potentially quite compelling valuation right now.
Let's summarize the bull case again. What are the key positives?
Okay, the bull case. You've got best-in-class underwriting discipline, masterful cycle management using that three-pillar structure, a proven, aligned management team with, remember, over $1 billion of their own money invested, that fortress balance sheet providing resilience, and an attractive valuation trading well below historical norms and significantly below the DCF intrinsic value estimate of around $140 versus the current $90 price.
Okay, sounds compelling, but what about the bear case? The reasons for caution?
The bear case is definitely real, too. There's the inherent earnings volatility from unpredictable catastrophes that's just part of the business. There are clear macroeconomic headwinds, persistent inflation, the specific impact of those potential 2025 tariffs. There has been some recent insider selling, even if it might be explainable. And you have that negative short-term market sentiment with the stock trading below its moving averages.
So strong fundamentals versus current headwinds and market caution.
Exactly. The analysis really points to a significant disconnect, potentially, between Arch Capital's current market price and what its intrinsic value might be based on those fundamentals.
So for a patient investor, someone with a long-term view focused on value, it seems like the stock appears significantly undervalued.
That's the conclusion the analysis leans towards, yes. While the market's caution isn't baseless, the risks are real. Arch's management team has that proven playbook for navigating choppy waters, and historically, they've often come out stronger.
Which leaves us with a final thought, maybe a question for listeners to consider.
Right. In this world of, let's face it, increasing global uncertainty, rising catastrophes, economic challenges, can Arch Capital Group continue its pretty remarkable legacy of turning that chaos into opportunity? Can they keep delivering superior value for shareholders who are willing to look past the short-term noise and focus on the long-term strengths?
Something to definitely think about. And if you found this deep dive valuable, if you want access to more detailed research reports, like the one that informed our discussion today, you might want to check out Stock Analytics AI.
Members get priority access to deep dives on all S&P 500 stocks. We're covering all of them over the next few months for just $4.99 a month.
And if you just want a one-off report on a specific company, you can even request one by dropping a super thanks on the platform.
But please do remember, this analysis, it was generated by an AI system, and it's purely for educational purposes. It should definitely not be taken as financial advice.
Absolutely. Always do your own homework, conduct your own research, or consult with a qualified financial advisor before making any investment decisions.